Welcome to a podcast about anything, where we dive deep into some of the most pivotal moments in modern history and their impact on our world. Today, we're tackling an event that reshaped global economies, affected millions of lives, and continues to echo through our financial systems: the 2008 financial crisis. Often referred to as the Great Recession, this wasn't just an economic downturn. It was a global event that wiped out trillions in wealth, left millions unemployed, and caused a seismic shift in how we view financial institutions and governments. From the collapse of housing markets to the failure of major banks, this crisis exposed deep vulnerabilities in the global economy. The consequences were far-reaching. No country was spared. Stock markets crashed, businesses shuttered, and entire nations faced crippling debt. More than just numbers and statistics, the Great Recession triggered a wave of foreclosures, job losses, and a fundamental shift in how we think about financial stability. Its effects are still felt today, whether in economic policy, housing prices, or job markets across the globe. In today's episode, we'll break down how it all started, the key events that led to its unraveling, and what we can learn to prevent such a catastrophe from happening again. So, sit back and let's journey back to 2008, the year the global economy hit its biggest crisis since the Great Depression. To understand how the 2008 financial crisis began, we need to look back at the early 2000s, a period when the U.S. housing market was booming. At the time, homeownership was seen as a key part of the American dream. Housing prices were rising rapidly, creating what seemed like an endless source of wealth for homeowners and investors alike. For years, buying a home was considered one of the safest investments, and this perception created a false sense of security across the financial sector. Lenders and investors saw these rising home prices as an opportunity. Since property values were expected to continue climbing, banks were more willing to issue mortgages, believing that even if a borrower defaulted, they could simply resell the property at a higher value. As a result, traditional lending standards began to loosen, and this set the stage for what would become a major problem: subprime mortgages. Now, subprime mortgages are loans given to individuals with low credit scores, people who wouldn't typically qualify for a conventional mortgage. These borrowers were seen as high risk because they often lacked the financial stability to meet their monthly payments. But as home prices soared, banks figured that the risk was worth it. After all, if a borrower couldn't pay, the bank could just foreclose on the house, sell it at a profit, and move on. This led to a flood of risky loans being issued, with some mortgage products designed to be enticing in the short term, like adjustable-rate mortgages that started with low interest payments, only to balloon later. The assumption was that home prices would keep rising, and borrowers could always refinance or sell their homes before those payments became unmanageable. But this created a ticking time bomb. As more and more subprime mortgages were issued, the housing bubble continued to grow. Investors, fueled by greed and the belief that the housing market was unstoppable, kept pouring money into mortgage-backed securities, essentially bundles of these risky loans packaged and sold as investments. It seemed like a win-win for everyone involved, but what they didn't see coming was that the market, like any bubble, would eventually burst. And when it did, the fallout would be catastrophic, not just for the homeowners caught in the subprime mortgage trap, but for the entire global financial system. But we'll get into that in the next segment. To truly understand how the 2008 financial crisis spiraled out of control, we have to examine some key changes in the financial system that started long before the housing bubble inflated. One of the major drivers of risky behavior in the banking sector was the wave of financial deregulation that took place in the 1990s. At the time, there was a strong belief in free markets and the idea that less regulation would encourage growth and innovation. In 1999, the Glass-Steagall Act, a key piece of legislation from the Great Depression that separated commercial banking from investment banking, was repealed. This change allowed commercial banks, which take deposits and issue loans, to merge with investment banks, which focus on trading and riskier financial activities. Suddenly, Financial institutions had more freedom to engage in highly speculative investments using the money of everyday depositors. This environment of deregulation set the stage for the creation of complex and, as it turned out, dangerous financial products like mortgage-backed securities and collateralized debt obligations. So, what exactly were these products and how did they play a role in the crisis? Mortgage-backed securities, or MBS, were bundles of home loans sold as investments. Banks and financial institutions would pool together thousands of mortgages and sell pieces of this pool to investors, who earned returns based on the mortgage payments. The idea was that housing was a stable market, so these securities were considered safe, even though many of the underlying mortgages were subprime and risky. As more people defaulted on their mortgages, the value of these securities plummeted, but we'll get to that shortly. Collateralized debt obligations, or CDOs, were even more complex. These were essentially bundles of different types of loans, including mortgages, sliced into tranches or layers based on risk. Investors could buy the safest tranche with lower returns or take on more risk by buying the lower-rated tranches, which promised higher returns. CDOs created an illusion of spreading risk, but in reality, they were heavily reliant on the housing market staying strong. The problem was that as demand for MBS and CDOs increased, banks were under pressure to issue more mortgages to meet this demand, leading them to relax lending standards even further and dive deeper into subprime loans. These products not only spread the risk across the entire financial system but also amplified it. When the housing market started to collapse, the ripple effect across banks, investment firms, and even insurance companies was catastrophic. The lack of regulation over these financial products meant that they were largely hidden from view, and the true level of risk was misunderstood, or, in some cases, outright ignored. As we'll see in the next segment, when the housing market started to unravel, it set off a chain reaction that would lead to one of the worst financial crises in history. Another crucial piece of the puzzle that led to the 2008 financial crisis was the role of low interest rates and risky lending practices in the early 2000s. After the dot-com bubble burst in the late 1990s and the shock of the 9/11 attacks in 2001, the U.S. economy was struggling to regain its footing. In response, the Federal Reserve under Chairman Alan Greenspan took a decisive step. It slashed interest rates to historic lows. By 2003, the federal funds rate was down to just 1%, making borrowing incredibly cheap. The idea behind these low interest rates was to stimulate economic growth by encouraging consumers and businesses to borrow and spend more. And in many ways, it worked, at least temporarily. People began taking out loans to buy homes, cars, and other big-ticket items. The housing market, in particular, experienced a massive surge as more people could afford to buy homes with these cheaper loans. However, this environment of easy money had some unintended consequences. With interest rates so low, banks and financial institutions found themselves flush with cheap capital and began looking for ways to maximize their returns. As a result, they started taking on more and more risk in their lending practices. Lenders relaxed their standards, offering mortgages to people who would have been considered too risky under normal circumstances, those subprime borrowers we mentioned earlier. But it wasn't just the loans themselves that became riskier. Financial institutions also became over-leveraged, meaning they were borrowing large sums of money to make even larger bets. Instead of holding on to safer assets, banks began bundling and selling risky mortgages as mortgage-backed securities, MBS, and collateralized debt obligations, CDOs, which we discussed earlier. The goal was to take advantage of the housing boom and make huge profits. In the process, banks became dangerously exposed to the housing market. They believed that as long as home prices kept rising, the risk of borrowers defaulting on their loans was minimal. But as we know now, that was a massive miscalculation. As more and more risky loans were issued, the foundations of the housing market grew weaker. When interest rates eventually began to rise again in the mid-2000s, those low initial mortgage rates ballooned, making it difficult, if not impossible, for many homeowners to keep up with their payments. The wave of defaults that followed was the first sign of trouble, and as these mortgages went bad, it sent shockwaves through the financial system. Banks, investment firms, and insurance companies that had taken on too much risk were now facing huge losses. The over-leveraged financial system began to collapse under the weight of its own risk, leading to the economic turmoil that would soon engulf not only the US but the entire global economy. As we'll explore in the next segment, this was just the beginning of a chain reaction that would eventually bring the world's financial system to the brink of collapse. By 2006, the cracks in the housing market that had been slowly forming over the years started to widen. After years of explosive growth, home prices across the United States peaked and then began to fall. What had once been seen as a never-ending rise in property values was suddenly coming to an end. The situation was particularly dire for those with subprime mortgages, borrowers who had been approved for risky loans with little consideration for their ability to repay them. As home prices fell, many of these borrowers found themselves underwater, meaning they owed more on their mortgages than their homes were worth. For homeowners with adjustable-rate mortgages, the situation became even worse as their monthly payments ballooned due to rising interest rates. Unable to sell their homes for a profit or refinance, more and more people started defaulting on their loans. This wave of mortgage defaults was concentrated in the subprime market, but its effects spread rapidly throughout the financial system. Why? Because of the enormous role that subprime mortgages had come to play in the world of finance. As we mentioned earlier, banks had bundled these risky loans into mortgage-backed securities and sold them to investors all over the globe. These MBS were often layered into even more complex financial products like collateralized debt obligations, which were supposed to diversify risk. But in reality, they spread it even further. When borrowers began defaulting on their mortgages, the value of these MBS and CDOs started to plummet. Financial institutions that had heavily invested in these products were suddenly exposed to massive losses. And the problem was nearly everyone, from major banks and hedge funds to pension funds and insurance companies, had invested in these so-called safe securities. It turned out that the risk had not been diversified at all. In fact, it had been amplified. Lehman Brothers, Bear Stearns, and other major financial players had massive stakes in these toxic assets. As the housing market collapsed, their balance sheets began to hemorrhage. Panic spread through the financial sector, as institutions realized that the assets they once thought were rock solid were now virtually worthless. The collapse of the housing market wasn't just a real estate problem, it was a financial catastrophe. As home values sank and defaults skyrocketed, the MBS and CDOs that were built on these mortgages became toxic, causing financial institutions to scramble to cover their losses. But for many, it was already too late. The wave of defaults and the ensuing loss of value in MBS set off a chain reaction that would soon bring some of the largest financial institutions in the world to the brink of collapse. In the next segment, we'll dive deeper into the banking meltdown that followed and how it became clear that this was no longer just a housing market crisis, but a full-blown global financial crisis. As the housing market collapse accelerated, the cracks that had been spreading through the financial system suddenly turned into a full-blown banking meltdown. By 2008, it was clear that some of the biggest names in the financial world were on the brink of failure. Let's talk about three key institutions whose collapse symbolized the severity of the crisis: Countrywide Financial, Bear Stearns, and Lehman Brothers. First, Countrywide Financial. At its peak, Countrywide was one of the largest mortgage lenders in the U.S., issuing billions of dollars in loans, including a massive number of risky subprime mortgages. As housing prices fell and mortgage defaults soared, Countrywide was left holding the bag. The company's reckless lending practices made it one of the first major casualties of the financial crisis. By early 2008, it was clear that Countrywide was in trouble, and it was sold to Bank of America in a fire sale, marking one of the first major signs of the crisis to come. Then came Bear Stearns. Bear Stearns was a major investment bank, heavily involved in mortgage-backed securities and other high-risk financial products. In early 2008, It became clear that Bear Stearns was drowning in toxic assets as the value of those mortgage-backed securities plummeted. In March 2008, just months before the full collapse of the financial system, Bear Stearns was on the brink of bankruptcy. The U.S. government stepped in to arrange a buyout by J.P. Morgan Chase, but at a shockingly low price, revealing just how quickly the bank's fortunes had turned. This was one of the first signs that the crisis was spreading beyond the housing market to major Wall Street institutions. The most dramatic failure came with Lehman Brothers, one of the largest investment banks in the world. Lehman had aggressively invested in mortgage-backed securities and collateralized debt obligations, thinking the housing market would never collapse. By mid-2008, it was clear that Lehman was sitting on billions of dollars of bad debt. Despite efforts to save the bank, including potential bailouts or mergers, no deal could be reached. On September 15, 2008, Lehman Brothers declared bankruptcy, marking the largest bankruptcy filing in U.S. history. The collapse of Lehman sent shockwaves through the global financial system, triggering panic in markets around the world. The failure of these banks wasn't just about poor management or bad luck. It revealed how deeply interconnected global financial institutions had become. Investment banks, hedge funds, insurance companies, and even pension funds had all invested heavily in the same risky mortgage-backed securities and CDOs. When the value of these products collapsed, it set off a chain reaction that threatened the entire global financial system. A key player in this web of interconnections was American International Group, or AIG, one of the largest insurance companies in the world. AIG had insured many of the risky assets that investment banks were holding through something called credit default swaps. Essentially, bets on whether certain loans would default. When the housing market collapsed, AIG was on the hook for billions in payouts, but it didn't have the cash to cover its obligations. In September 2008, just days after Lehman's bankruptcy, AIG was on the verge of collapsing. Fearing that AIG's failure would cause a total collapse of the financial system, the U.S. government stepped in with an $85 billion bailout to prevent further catastrophe. This interconnectivity meant that the collapse of one institution threatened others. When banks stopped trusting one another, credit markets froze, and the crisis spread from Wall Street to Main Street, and from the U.S. to financial centers across the globe. The failure of key institutions like Lehman Brothers and the near collapse of AIG triggered a global financial panic. Stock markets plunged, banks stopped lending, and economies worldwide entered a sharp decline. In the next segment, we'll explore how governments and central banks scrambled to respond, leading to unprecedented bailouts and interventions to stabilize the global economy. As the financial crisis deepened in 2008, the situation became so dire that governments and central banks around the world were forced to intervene on an unprecedented scale. The meltdown of major financial institutions like Lehman Brothers, the collapse of the housing market, and the panic that followed had pushed the global financial system to the brink of collapse. In this segment, we'll break down the U.S. government's response, the role of the Federal Reserve, and how other countries followed suit to stabilize their economies. First and foremost was the Troubled Asset Relief Program, or TARP. As the financial system teetered on the edge, the U.S. government recognized that immediate action was needed to prevent further bank failures and restore confidence in the financial markets. In October 2008, Congress approved TARP, a $700 billion emergency fund designed to inject capital into struggling banks. The goal was to shore up balance sheets, restore liquidity, and keep the financial system from imploding. Initially, TARP was intended to buy up toxic assets, like those infamous mortgage-backed securities, but it quickly shifted to direct capital injections into banks, effectively bailing them out. Through TARP, the U.S. Treasury bought equity stakes in banks, providing much-needed cash to institutions that were on the verge of collapse. This helped stabilize the financial system and reassured the public and markets that the government wouldn't let the entire banking sector fail. Major banks like Citigroup, Bank of America, and Goldman Sachs all received significant funds from the program. While controversial, with critics arguing it was a bailout for Wall Street at the expense of taxpayers, TARP is credited with preventing a complete financial meltdown. At the same time, the Federal Reserve played a crucial role in stabilizing the economy. Under Chairman Ben Bernanke, the Fed slashed interest rates to near-zero levels, making borrowing cheaper in an attempt to stimulate lending and investment. This was an extraordinary move, but it wasn't enough on its own. The Fed also provided unprecedented liquidity to banks and financial institutions through various lending programs, ensuring that banks had access to cash to meet their obligations and prevent a total freeze in credit markets. One of the most critical actions taken by the Federal Reserve was the creation of emergency lending facilities to support not only banks but also insurance companies, investment firms, and even major corporations. These programs pumped trillions of dollars into the financial system to keep credit flowing and avoid a collapse in day-to-day economic activity. This intervention was essential to preventing a much deeper and longer-lasting depression. But it wasn't just the U.S. that was in crisis. The interconnected nature of global financial markets meant that as the crisis spread, banks in Europe and other parts of the world were also facing major problems. Many European banks had invested heavily in U.S. mortgage-backed securities and other risky financial products. When the value of these assets collapsed, European financial institutions were left exposed to massive losses. Governments across Europe quickly moved to bail out their banks, with countries like the United Kingdom, Germany, and France launching their own rescue packages to prevent financial contagion from spreading. In the UK, for example, the government nationalized major institutions like Northern Rock and Royal Bank of Scotland, injecting billions into the banking system to prevent collapse. Similarly, Germany's government provided bailout funds to its banks, while the European Central Bank slashed interest rates and provided emergency liquidity to stabilize markets across the continent. This wave of government intervention was coordinated on an international scale, as world leaders, including those from the G20, recognized that a failure in one major economy could ripple across the globe. These efforts, while controversial and expensive, helped stabilize the global economy, at least in the short term. In the next episode, we'll look at the aftermath of these interventions, how they shaped economic recovery efforts, and the long-term consequences of the government's role in the financial system, including the debate over whether these bailouts ultimately helped or hurt the economy in the years to come. And that brings us to the end of today's episode. We've covered the build-up to the 2008 financial crisis, from the housing bubble, financial deregulation, and risky lending practices to the catastrophic collapse of key financial institutions. We also explored how the U.S. government, the Federal Reserve, and other global leaders stepped in with unprecedented bailouts and interventions to save the financial system from total collapse. But as we all know, the crisis didn't end with the bailouts. In our next episode, we'll dive deeper into the economic and social consequences of the crisis. We'll look at how economies across the globe were affected, how millions of people lost their homes and jobs, and the long-lasting ripple effects that continue to shape the financial landscape today. We'll also explore the human cost of the crisis, how everyday people were impacted by the decisions made on Wall Street, and the wider global implications, from Europe to Asia, as financial instability spread across borders. Finally, we'll discuss the lessons learned and the changes that were implemented in the aftermath. We'll cover the major financial reforms, like the Dodd-Frank Act, that aimed to prevent another collapse, and how the crisis reshaped our understanding of systemic risk in an increasingly interconnected world. So, stay tuned for the next episode as we dive into the aftermath and explore how the world responded to the biggest financial shock in recent history. Thanks for listening, and if you enjoyed this episode, don't forget to subscribe, leave a review, and share it with others who want to understand the events that reshaped the global economy.